Today's video is a step-by-step guide to understanding everything you need to know about an IPO or an initial public offering. I am That Finance Girl and I welcome you to another video. In today's video, we'll discuss the following. What is an IPO? The main distinguishing features between a primary market and a secondary market, the 8 steps involved in the IPO process, the advantages and disadvantages of a company going public, and some concluding remarks towards the end. Please refer to the timestamps in the description box if you'd like to navigate to a particular segment of the video. And now, without further ado, let's get started. What is an IPO? An IPO or an initial public offering is a process by which a privately held company offers its shares to the general public for the very first time. The company in question is said to be going public, which implies that it's no longer a private entity. Following an IPO, the company gets listed on one or more than one stock exchange and its shares begin trading publicly. An IPO is an example of a primary market, whereas a stock exchange represents the secondary market. Before we proceed to the steps in the IPO process, let's quickly understand the distinction between a primary market and a secondary market. When you buy a particular company's shares on the primary market, say through an IPO, you're buying them directly from the company. However, when you buy a company's shares on the secondary market, that is via a stock exchange, you're not buying them from the company. You're buying them from another investor, somebody who's willing to sell his shares. This is a distinction many people do not understand. Let me explain it in a different way. When you buy a company's shares on the primary market, the proceeds from the purchase go to the issuing company. However, on the secondary market, shares of a company are bought and sold amongst investors. The company is not involved in the transaction. IPOs, bonus and right share issues are some examples of primary market transactions, whereas examples of secondary markets or stock exchanges include the New York Stock Exchange, the London Stock Exchange, the Bombay Stock Exchange, etc. The IPO process can be explained in 8 easy steps. They are as follows. Please note that the Securities and Exchange Commission, also known as the SEC, or in the Indian context, the SEBI oversees the entire IPO process. We'll now go through each of the 8 steps in detail. The first step in the IPO process is the selection of an investment bank. The issuing company hires an investment bank. Multiple investment banks can also be hired depending on the size of the offering. The investment bank or banks act as underwriters on behalf of the company. Underwriters play a critical role and help the company facilitate the entire IPO process. They act as intermediaries between the company looking to issue shares and the public seeking to invest in the company. JP Morgan, Goldman Sachs, and Morgan Stanley are some prominent examples of underwriters. In the second step, the issuing company along with its team of underwriters files for registration with the SEC. The SEC, or the Securities and Exchange Commission, is a US-based regulatory body that works to safeguard the interests of investors. Its Indian equivalent is called SEBI, or the Securities and Exchange Board of India. The company must disclose all the information that the SEC seeks to know, such as its business plans, fiscal health, how it plans to utilize the capital it will raise through the IPO, etc. Only if the company complies with the stringent rules and regulations set by the SEC does it receive permission to proceed further. The third step in the IPO process consists of creating a prospectus. The issuing company and the underwriters compile all the important information about the company, such as details about the promoters, the company's past financial performance, its future plans, etc. in this document. This prospectus is an essential tool in the hands of the prospective investor. Anyone looking to invest in the IPO should go through this document very carefully because it contains all the information required to make an informed decision. Once the prospectus is ready, it's time to market the IPO. The company executives, as well as the underwriters, travel around the country or in some cases around the world promoting the IPO, hoping to generate interest amongst potential investors. The objective of this marketing activity, known as the Roadshow, is to create awareness about the offering and attract as many investors as possible. The next step in the IPO process is pricing. The issuing company and the underwriters decide on the number of shares that will be issued as well as the price at which the shares will be available. There are two types of IPOs, a fixed price IPO and a book building IPO. In a fixed price IPO, the share price is decided in advance. For example, if the share price is fixed at $50, the investor will have to submit his application at $50. In case of a book building IPO, however, a price band is specified within which an investor can submit his bid. For example, if the price band is from $100 to $120, the investor will have the option of bidding at a price within the band that he considers suitable. The lower limit of the price band is called the floor price, while the upper limit is called the cap price. Hence, in the above example, $100 is the floor price, while $120 is the cap price. A book building IPO is an efficient price discovery mechanism and is highly recommended by stock exchanges. The IPO is now open to the public. Those who wish to purchase the shares can now submit their applications. The IPO remains open for a minimum of 3 working days and a maximum of 10 working days. Once the applications have been collected, the issue price is determined and the shares are allotted to the applicants. In case of oversubscription, all of the applicants are not allotted shares. The final step in the IPO process is the listing of the company on one or more than one stock exchange. The issuing company is now a publicly traded company and its shares can be bought and sold on the open market. Please note that the IPO process is a complex procedure. This video has provided a broad overview of the topic and has attempted to present it in a simplified manner. The steps in the IPO process have to be followed in accordance with the guidelines specified by the SEC or the SEBI or the regulatory authority of your particular country. Now let's discuss the advantages and disadvantages of a company going public. First, let's take a look at the advantages. The greatest advantage of going public is that it allows a company to raise huge amounts of capital. This capital can be used to fulfill a company's capex requirements, or for the purpose of research and development, or for paying off past debts. The funds acquired through an IPO can also help a company scale up its business and grow multifold within a short time frame. An IPO helps generate publicity for a company. Being listed on a stock exchange helps the company gain credibility in the eyes of its customers, suppliers, etc. The increased public awareness can help the company acquire new clients, giving it an edge over its competitors. Moreover, going public can go a long way in helping businesses build their brand value. Once a company goes public, its shares start trading on the open market. Founders and early investors can use this as an exit opportunity. This means that they can sell their stake in the company, thereby cashing out on their investment. Another advantage of going public is that companies can provide incentives such as stock options to their employees. This is a great way for companies to attract and retain top-tier talent. Now let's take a look at the downsides of a company going public. The IPO process is extremely expensive and time-consuming. It requires a company to acquire the services of legal and financial professionals. This causes the costs to go up significantly. Expenses that a company incurs include the underwriter's commission, printing costs, accounting fees, legal fees, marketing costs, etc. Furthermore, the IPO process can take up anywhere between 6 months to 2 years. This tends to take up a significant amount of the management's time, thus distracting them from running the business. Another disadvantage of going public is the company's loss of control and confidentiality. A public company is answerable to its shareholders. Since shareholders are essentially part owners, they too have a say in the company's decision making. Moreover, being listed on a stock exchange requires a company to comply with certain rules and regulations and also to publicly disclose extensive information about the business. This could prove detrimental to the company as business sensitive information would be easily available to competitors. Despite its disadvantages, the IPO process is very beneficial for a country's economic growth and development. An IPO serves as a great tool for entrepreneurs who possess talent, skill, and capabilities but fall short of funds. IPOs help generate wealth as well as employment. Countries should work on developing a robust regulatory framework to help minimize misuse of the system by fly by night operators and fraudsters. IPOs can go a long way in helping build and nurture an entrepreneurial spirit in the youth. All in all, the benefits of the IPO process far outweigh its drawbacks. I hope this video helped you understand everything about IPOs. If you liked my video, please subscribe to my channel. Also hit the bell icon to be notified whenever I publish a new video. Please hit the like button and share this video with other stock market enthusiasts. If you have any questions or suggestions, feel free to leave them in the comments. I'll make sure to respond to every single one of them. Thank you for watching my video. Take care and I'll see you in the next one.